Yo, what's up everybody? Moving on with long-term financial planning. In this video, we're going to cover the concept of the internal growth rate. And more specifically, what the internal growth rate means is the growth a firm can maintain without any external financing. And to better explain the internal growth rate, I'm going to illustrate it through an example. Now, if you don't feel like writing out this example, I put a link to lecture notes in the description box for convenience. So you don't have to write this out, you can just print those out instead before continuing on this video. So in this specific example, we have the two most recent financial statements, the income statement and the balance sheet. So the income statement has a net income of $3,000, the balance sheet has assets of $40,000, and then debt and equity of $18,000 and $22,000 respectively, and then both sides balance. And in addition to the financial statements, we're also told that the assets and costs vary with sales, or they're proportionate to sales. The debt and equity do not vary with sales. And then also a dividend of $1,200 was paid on this net income, and the company wishes to maintain a constant payout ratio for the future. And then let's say we're asked, how much can sales grow without any external financing, or with just internal financing? And to answer this question, we have to find the internal growth rate for the firm. But before getting into the internal growth rate specifics, I want to talk about this piece of information here, this dividend of $1,200. So what happened was we had our net income of $3,000, $1,200 of that was paid as a dividend, and that means the balance, $1,800, was retained earnings, retained within the company for growth. And with that information, we can figure out something called the payout ratio. And the payout ratio is just basically equal to the dividends over the net income. So taking the dividends of $1,200 and then dividing by the net income of $3,000, we would get a payout ratio of 0.4 or 40%. So 40% of the net income was paid out as dividends, and the company wants to maintain that payout ratio of 40% in the future. Similarly, the retention ratio is basically what percentage of net income was retained in the company. And the retention ratio is just basically equal to retained earnings, which I symbolize as RE here, all over the net income. So plugging those values in, the retained earnings of $1,800 over the net income of $3,000, we would get a retention ratio of 0.6 or 60%. And those numbers of 0.6 and 0.4 make sense because the payout ratio plus the retention ratio, it always has to equal 1. So 0.6 plus 0.4 equals 1. So sometimes you'll just be given the payout ratio or the retention ratio, and you can figure out the other ratio by just doing 1 minus the ratio you were given. Now let's get back to our original question. How much can sales grow without external financing? And as I mentioned, we have to calculate the internal growth rate. So I put the formula here for it. So the internal growth rate is equal to the return on assets, which I denoted as ROA here, times the retention ratio, all over 1 minus the return on assets times the retention ratio. Now the retention ratio we already have, it's 0.6 or 60%, but this return on assets we don't have, and we can figure that out because return on assets is basically equal to the net income over the assets. And we can get these figures from the financial statements. So the net income is $3,000, the assets is $40,000. So if you divide these two numbers in your calculator, you would get 0.075 or 7.5% return on assets. And now, since we have the return on assets and the retention ratio, we can figure out what our internal growth rate is. So now taking those values and plugging them into the formula, we got our return on assets of 0.075 times our retention ratio of 0.6 all over 1 minus the return on assets again of 0.075 times the retention ratio of 0.6. Now notice how the return on assets and the retention ratio is in decimal format. It's not in percentages. So always make sure when you're using this formula, return on assets, retention ratio, they're in decimals. And then plugging those values into your calculator, you would get 0.04712, or in percentages 4.712%. So that's the maximum that the sales can grow for this company without any external financing needed. Now to really drive the point home and to really understand this concept, let's test it. Let's actually take this company, let's create some pro forma financial statements by growing the sales by this amount, and then seeing whether we actually don't need any external financing. So let's start off by making the pro forma income statement. So the sales figure, well, we're going to grow the sales figure of 15,000 by this 4.712%. So we would multiply it by 1.04712. So then plugging that value into your calculator, you would get $15,706.8. So that would go here for the sales amount. And then we would do the same for costs, because as was mentioned in the beginning of the example, the costs vary with the sales. So they're proportionate, so they're going to grow at that same percentage. So taking that 12,000, multiplying it by 1.04712, you would get 12,565.44, and then subtracting those two, you would get a net income of 3,141.36. Now with this net income, we can also find out what the dividends are forecasted to be, because it was said that the company wants to maintain a constant payout ratio, and we already figured out that the payout ratio is 40%. So to find the dividends, we can just take the net income of 3,141.36 and then multiply it by that payout ratio of 40%, or in decimals of 0.4. So then multiplying those out, we would get dividends forecasted of 1256.54, and I wrote that down here just below the net income. Now let's get into making the pro forma balance sheet. So we're told that the assets vary with the sales, so they're proportionate to the sales. So this 40,000, it's going to grow by this internal growth rate as well. So we'll multiply that 40,000 by 1.04712, and we will get an asset figure of 41,884.8. The debt will stay the same, because remember, we're not taking on any external financing, so no extra debt, so that figure stays the same. And to find that equity figure in the balance sheet, we can use the formula that we've been using this whole chapter. So the beginning equity plus the net income minus the dividends gives us the ending equity. Or you can also rewrite it as the beginning equity plus the retained earnings, because that net income minus dividends gives you the retained earnings. But in this case, we only have the net income and dividends. We could have found the retained earnings by subtracting these, but let's just use this formula for now. So then taking these figures from the financial statements, the beginning equity is the 22,000 plus the net income of 3141.36 minus the dividends of 1256.54. That gives us a new ending equity amount of 23,884.8. So then that amount would go here for the equity section, and now we're done the balance sheet and we can take the totals of both sides. And now notice when we add up everything for the balance sheet, both sides are going to balance at this figure of 41,884.8. And that means that there's no external financing needed. Because if you remember, when we did need external financing, this left side was bigger than this right side. But because we grew the sales, the assets, the costs at this internal growth rate, and the internal growth rate is basically the growth a firm can maintain without any external financing, well, it seems like this is a legit formula because we just proved it with these pro forma financial statements. And if you want to take it even a step further, what you can do is you can redo this whole process and pick a rate that's a little bit greater than this. So let's say that we grew everything by 6%, or we just grew the sales by 6%. If you do that whole process, I'm not going to do it, you can do it yourself just for practice, you would end up getting an external financing needed of 492. Basically at this last step, this left side is going to be greater than this right side by that amount. So I would suggest that you pause the video and try that yourself. Basically the point is any growth that this company wants to have over 4.712% or over its internal growth rate, you're going to need, or they're going to need, external financing. Now, the type of questions for internal growth rate that you're mostly going to see are going to be more simple than this. You're not going to have to make these pro forma financial statements all the way and then show how it balances. Basically, an example of a question that you may get is something like, you have this company here, how much can their sales grow to before they need any external financing? So all you would have to do is you would have to figure out the internal growth rate, and then before that you would also obviously have to figure out the return on assets and the retention ratio, but that's not too bad. Then once you get that internal growth rate, you would just grow that sales amount by that internal growth rate, and you would get this final sales figure of 15,706.8. So the sales can grow to this amount before any external financing is needed. I just wanted to go all the way making these pro forma statements just to show you how it all balances in the end. Yo, what's up guys? Thanks for checking out my channel. Hopefully you got some value from the video you just watched. If you did get some value, big favor to ask you, please like this video and subscribe to the channel. Any questions, any recommendations on things you'd like to see, please leave it in the comments section. Also check out the description box below for links to material and content related to the video you just watched. Peace out.